Hello and welcome. As a value investor, I'm always on the hunt for those big structural shifts, the kind that can create wealth for decades. And today, we're going to break down one of the biggest transformations happening anywhere in the world, India's defense sector. I built a framework to cut right through the noise, and I'm going to walk you through it step by step. Let's get started. Everything, and I mean everything, hinges on this one powerful idea. What we are witnessing is a massive structural shift. This isn't some trend that's going to fade away in a year or two. No, this is a fundamental rewiring of a huge industry, a move from being dependent to being self-reliant. And for a long-term investor, these are exactly the kind of tectonic shifts that can build generational wealth. So here's how we're going to do this. We're going to approach it like a funnel. We'll start at the very top, the big picture, the macro tailwinds. Then we'll drill down, layer by layer, through government policy, the industry structure, company strategies, and the specific financial tools we need. By the time we're done, we'll be ready to make a truly informed investment decision. Okay, first things first, why now? What's happening in the world and right here at home that's creating this pretty unique investment landscape? Let's start with the global picture. Let's start with a number, 61. In 2024, there are 61 active conflicts around the globe. That is the highest number since the end of World War II. This is the reality of the world we're living in. It's an era of rising instability, and for countries, this isn't some abstract idea. It's a direct reason for sustained long-term defense spending. As an investor, this is a powerful, non-negotiable tailwind for the whole sector. Now, here's what really gets my attention. Despite all that global instability, India's defense spending as a slice of its GDP is actually near a multi-decade low. I mean, look at this. Historically, during tense times, this number has been as high as 4.8%. This tells us there is massive headroom for growth. Any major geopolitical event could easily push spending back towards that historical average. We're talking about a potential doubling from here. And for India, believe me, this need isn't abstract. It's driven by four core strategic realities. The military has to be ready for a potential two-front conflict with both China and Pakistan. It has to counter China's strategic encirclement through its string of pearls port strategy. It needs a credible deterrent to China's wider expansionism. And on top of all that, it has to be prepared for any instability spilling over from Pakistan. These aren't choices. They are absolute necessities. And if you want to see just how urgent this is, just look at these numbers. Combat aircraft, India has 580, China has 3,000. Destroyers, 12 versus 62. This isn't just about a gap in hardware. It's about a strategic imbalance that is lighting a fire under India's push for rapid modernization and self-reliance. This right here is the why behind the entire investment thesis. The war in Ukraine was a massive wake-up call for the entire world. It was a stark reminder that modern wars are not just won on the battlefield. They are won in factories. Europe was shocked to discover it had a huge capacity deficit, literally unable to produce enough shells. At the same time, Russia turned its industrial might into a weapon, cranking up factory output 2.5 times. The key lesson here, industrial capacity is now a core strategic advantage. Okay, so we've got the macro why, but a big picture need isn't enough, right? For an investment thesis to work, that need has to be channeled into a real, tangible market. And that's exactly where government policy comes in. Basically, architecting a protected playground for domestic companies to thrive. The government's whole strategy, called Atmanirbhar Bharat, or Self-Reliant India, is built on these 7 key pillars. We're talking specific, actionable policies designed to create a captive market, make buying stuff easier, and guarantee the money is there. It's a really powerful interlocking framework that essentially de-risks the entire domestic industry for long-term investors. Now, out of all those policies, there is one you absolutely have to understand: the positive indigenization list. This isn't a suggestion, it's a rule. It is a straight-up ban on importing certain items after a specific date. So if you're an Indian company that can make those items, this policy is basically a government-guaranteed order. It creates a protective moat around the domestic market. It's a game changer. And look, this isn't just theory. The proof is in the pudding, as they say. Just look at the real-world impact on the big public sector companies. HAL jumped from 4% profit growth to 22%. BEL more than doubled its growth rate. And BDL, well, it went from shrinking profits to a solid 11% annual growth. This is crystal clear evidence that these policies are working. All right, so we've got the macro tailwinds and we've got the policy support. Now it's time to get our hands dirty and map out the industry itself. To be a smart investor, you have to know who the players are and, just as importantly, where they fit in the food chain. So at the very top of the pyramid, you've got your Tier 1 companies. These are the giants, the ones that build the final big-ticket platforms. We're talking fighter jets, aircraft carriers, tanks. The good news is they have massive multi-year order books. The catch is that their business requires a ton of capital, and the project cycles can be very long. Right below them, you have Tier 2, the subsystem suppliers. Now, this is where a lot of the high-tech magic happens. These companies build the brains and the nervous systems of the platforms, the radars, the communication systems, the electronic warfare suites. From an investor's point of view, this tier is often really attractive because these companies can have more diverse customers and, crucially, the potential for much higher profit margins. Next, we drop down to Tier 3. These are the companies making the essential building blocks. They could be making specialized steel forgings, high-performance cables, or other unique components. They often have a deep niche expertise, which creates a really strong competitive moat around what they do. And at the very bottom, the foundation of it all is Tier 4. These are the folks producing specialized raw materials like warship-grade steel. They're absolutely critical to the whole ecosystem, but as investors, our focus is usually going to be on those higher tiers where more of the value is added. So let's boil it down. What's the key takeaway for us as investors? Well, Tier 1 offers stability and incredible revenue visibility, but it can be heavy on capital. Tier 2, on the other hand, is often the sweet spot. That's where you can find higher growth potential, better margins, and a growing share for the private sector. This is often where I focus a lot of my own research. Okay, we know the playing field. Now let's talk about how the players actually win the game. Understanding a company's specific strategy for growth is an absolutely critical part of our analysis. And we've identified 5 key growth strategies. Is the company driven by its own intellectual property? Is it trying to move up the value chain? Is it diversifying into the super profitable MRO business that's maintenance, repair, and overhaul? Is it looking at exports? Or is it using its skills in totally different sectors? Let's zoom in on a couple of these. Okay, let's talk about MRO. This is a part of the business that a lot of people just overlook, but frankly, it can be a gold mine. For a company like HAL, a whopping 70% of its revenue comes from MRO. But check out Cochin Shipyard. MRO is 38% of its revenue, but it drives an incredible 62% of its profits. The lesson here is simple. Servicing equipment over its 30 or 40-year lifespan is often way more profitable than building it in the first place. It provides stable, recurring, high-margin cash flow. Now, when we look at exports, it's crucial to understand that not all export models are created equal. Built to print is basically like being a contract manufacturer. The customer gives you the blueprints, you build it. It's low risk, sure, but it's also low margin. Built to spec, on the other hand, that's when a company owns the design, the intellectual property, the whole shebang. That is where the real value is created, commanding margins that are 4 or 5 times higher. For long-term value, built to spec is the holy grail. All right, time to open up the toolkit and talk numbers. But here's the thing, you can't just use your standard metrics here. Things like the PE ratio, they just don't tell you the whole story in this sector. You need specialized tools to really get a grip on the financial health and future of a defense company. If you remember only one metric from this entire analysis, make it this one, the order book to revenue ratio. It's a direct measure of future revenue visibility. A ratio of, say, 4x means the company has 4 years of work already lined up and confirmed. I mean, think about that. That kind of long-term visibility is incredibly rare, and it completely changes how you think about risk and valuation. Next up, we have to check the company's pulse, and we do that by looking at margin trends. Are their profit margins expanding, stable, or shrinking? Expanding margins, like we see with BEL and Mazagon Dock, that's a great sign. It suggests pricing power and good execution. But contracting margins, like we see with data patterns, that is a major red flag. It could signal intense competition or some serious internal problems. And high volatility, like with BDL, just tells you that earnings are unpredictable. And finally, a simple but crucial question. How much of this company is actually a defense company? We call this business purity. A company like BEL is a pure play at 90%, so you get direct exposure to the defense story. Others are more diversified, which can act as a hedge if defense budgets get tight. There's no right or wrong answer here, but you absolutely need to know what you're buying into. Okay, this is it. We've built the entire framework. We've gone from the 30,000-foot macro view through policy, the ecosystem, strategies, and right down to the metrics. Now let's put it all together and apply it to a real-world example to see how it helps us make a decision. So let's take a company that, on the surface, looks like an absolute superstar: data patterns. I mean, a 5-year compound annual growth rate of 33%. That is impressive in any industry. This is the kind of number that gets a lot of people very excited. But as disciplined, long-term investors, we have to look past the shiny headline number and ask the tough question: what does the recent data actually show? Is the story still intact?
And when we apply our framework, a bunch of red flags start popping up. Both their profit after tax margins and their EBITDA margins are shrinking, and, most critically for a defense company, its order book has declined. This tells a completely different story from that historical growth rate. It tells us the fundamentals are actually weakening. And we're not the only ones to notice. This quote from an analyst confirms the market's concern. The order book is looking very, very low. Remember what we said? A weak order book is the most concerning sign there is for a defense company, and it directly contradicts that high-growth story. So this is the final output of our entire process: a clear, data-driven decision matrix. When we systematically score companies like BEL and HAL across our framework, they come out looking really strong. But data patterns? It scores poorly on financials, on valuation, and on risk, leading to a clear avoid recommendation. This framework allows us to cut through the hype and make disciplined, evidence-based decisions.
So there you have it. We've laid out a comprehensive framework, a map, really, to help navigate the massive structural transformation happening in India's defense sector. It's a multi-decade story, grounded in powerful global and domestic forces. The opportunity is there. The map is clear. The only question left is, are you prepared to follow it?